Good afternoon. Good afternoon. It's Monday, the 29th of July. Welcome to another edition of Monday Market Picks. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities in Singapore. It's great to be back after a 2-week vacation. And we are straight into central bank watch. Central banks from Tokyo to London to the Fed will be meeting this week, which means that there will be a lot of speculation in terms of rate cuts as well as rate hikes. So will the BOJ finally decide to hike this week? And will the Fed give some indications of cuts going forward? So that's something that's going to impact our markets as well. We've got Brian, our economist, who's joining us to talk about the latest MAS guidance forecast in terms of GDP. And some of that is actually predicated on interest rate cuts in the second half. We also have Husseini, who's joining us. He's going to be talking about the regional telecom sector and how, if interest rate cuts start to come through, how does that impact the sector, and some top picks as well. Krishna is going to be joining us, or he will actually, he's written a note highlighting the REIT sector, which is also a very interest rate sensitive sector, and especially some new proposed rules in terms of leverage that is coming through. And then we also have a high conviction idea from Jarek. He thinks is just about to take off with the first half results coming through. As always, if you haven't downloaded our newsletter this week, you can do so by clicking through to the QR code that will come on your screen right now. And at the same time, you can, we will talk a little bit about the key market moves for last week. The US markets were pretty volatile, a lot of volatility on the tech sector, but we did see a turnaround towards the end of the week with early bets coming through on rate cuts. China also saw some pretty decent recovery last week, largely after the Central Communist Party's meeting there. ASEAN was a little bit mixed, with Singapore and Malaysia seeing some profit taking coming through. Now, let's start with economics, and let's welcome Brian to the show. Now, Brian, the MAS has raised their GDP forecast outlook to 2 to 3% for 2024, and that's a jump up from 1 to 3% earlier. What's driving this optimism, and how does this sit with our own Maybank forecasts?
Yeah. So indeed, the MAS expects growth momentum to improve in the second half of 2024. I think it highlighted especially the manufacturing and financial sectors, which will be bolstered by the broadening tech upturn and also the expected decline in global interest rates, with the Fed, for instance, expected to start cutting from September, according to the markets, and so on. We recently actually lifted our GDP growth forecast to 3% from 2.4% previously, after a robust first half performance. Our forecast stands at the upper bound of MAS revised forecast range.
Okay, so we're quite optimistic going into the second half. How is the central bank in Singapore? How are they seeing inflation right now?
Yeah, so MAS expects inflation to fall more discernibly from the current level of about 3% thereabouts for core inflation. It expects this 3% to be somewhat sticky until it starts to fall more discernibly from the fourth quarter. And MAS is expecting that domestic unit labor costs will rise at a significantly slower rate as tightness in the labor market dissipates, and also that labor productivity picks up. It did, however, highlight that higher shipping rates with the ongoing port congestion may pose an upside risk to inflation. So MAS actually maintained its core inflation forecast for the full year at 2.5% to 3.5%. However, MAS lowered its headline inflation forecast to 2 to 3% from the previous 2.5% to 3.5% range, and that's mainly reflecting lower private transport inflation in recent months due to the increase and bringing forward of COE quotas.
Right, right. So, Brian, what does this mean for MAS policy? Do you think they will start to cut soon in terms of their Singapore dollar appreciation policy, or do you think they will wait?
Yeah, so we are expecting MAS to maintain its current appreciation stance for the rest of 2024 as growth continues to recover towards its potential rate, while core inflation remains somewhat sticky for most of the remaining months of this year. Our base case is for MAS to ease policy via a slight change of the slope only at the January 2025 meeting as core inflation falls more discernibly to around 2% or so. We think MAS will want to ensure that the job on tackling inflation is finished before taking the pedal off.
Okay, so a lot more cautious central bank here in Singapore. Thanks,
Yes.
Brian, for joining us and with those insights.
Thank you.
Okay, now, some of the other regional central banks, and particularly the Fed, might not be as cautious, and that's what a lot of the markets are betting for, with expectations of early interest rate cut coming through in the second half from the Fed. So I think this is a good time to bring Hussaini on the line. He's done a very detailed piece on the regional telco sector, looking at what a scenario of interest rate cuts will have on the regional telcos and whether investors will start to rotate into that sector. So Hussaini, welcome to the show.
Hi, thanks, Thilan. I hope you can hear me well. Thanks
Yes,
for
we
having me.
can. So, Hussaini, you are arguing that when interest rates start to come down, telcos will be a rotational beneficiary. Can you talk us through the historical correlations that you've looked at to base your views on?
Yeah, sure. Thanks. So, telcos are usually seen as a defensive and dividend yield plays. We see telco share price has a strong negative correlation to the long-term US bond yields. So in simple terms, if the bond yields goes up, telcos underperform, and when the bond yield goes down, telcos outperform. So from the historical point of view, if we see from 2009 to 2019, the correlation of ASEAN telcos to US bond yields had been around 60%, and it is on figure second of the report. And if we see for the last 18 months, which is from, or maybe for the last 2.5 years, from 2022 to first half of 24, the correlation had been around 90%. So as such, we see a quite strong correlation of telcos to bond yields. Even telco as a sector underperformed the broader market during a rising interest rate yield and or rising interest rate cycle, and outperform in a down interest rate cycle. And this can be seen on figure 3 and 4 of the report, that the negative correlation relative to the market had been 60 to 65% negative correlation to the US bond yields. So in conclusion, telcos should be a strong beneficiary of the falling interest rate cycle in our view.
Right, so that's something to watch out for. Now, you've taken the report one step further, and you've done a framework, 5-factor framework, to identify the stocks that will benefit the most out of interest rates coming down. Can you talk us through, what this framework is, and also what have been your key picks for the sector?
Yeah, sure. So we put a framework to identify the frontline beneficiaries of the down interest rate cycle, and those factors are, by the way, it is on figure 11 of the report, and those factors are first, share price correlation to bond yield, we just discussed. Second and third factors are what is the dividend yield to bond yield spread. This means that as bond yield falls, telcos with superior dividend yield or dividend yield to bond yield spread will benefit the most. The fourth factor is net debt to EBITDA. Now, having a high leverage is not a virtue. However, in a falling interest rate environment, companies with high net debt to EBITDA or high interest cost will be the bigger beneficiaries as their interest expense goes down and their earnings get lifted. And the final factor is change in capex intensity. So telcos which are going to see a falling capex intensity will have a bigger room to increase their dividends, and those names in our view will be the beneficiaries.
Right.
So given this 5-factor framework, we rank telcos on this. And from the Singapore investor standpoint, 2 names which flag out or which flag are, first is Netlink Trust, and the second is AIS in Thailand, which Singapore-based investors can get exposure through SDRs.
Right. AIS and Netlink. Any other regional picks that you have that?
Yeah, sure. So as seen on figure 11, other names which flag are PLDT and Globe in Philippines, and means they flag very favorably. But one area where they flag very nicely is the falling capex intensity. So for those names, capex intensity was 40 to 50% in the last 3 years, which in our view is going to 20 to 30%. So they are going to see a big increase in their free cash flow on the back of that. Then we also flag AIS and True flag very favorably. Both are Thailand-based telcos.
So just 1 minute, Hussein. Let's get the charts up on screen for these stocks so that our investors can follow a little bit better. Okay, carry on, please.
Yeah. So PLDT, Globe, AIS, and True in Thailand. There are 3 more names which flag very favorably, which are the telco infrastructure names called DIF and 3BBIF in Thailand. Means those companies offer 9 to 10% dividend yield and very stable revenues in our view. So flag very favorably. And the last name, which is Netlink Trust.
Got it. Now, you mentioned AIS earlier, and you also flagged that as a beneficiary of dividend yield. There was also restructuring announced at the parent level as well. Can you share some background in terms of the restructuring, and does this restructuring create some additional upside catalysts for the stock?
Yeah, sure. So first of all, AIS flags very favorably on our screens on the 5-factor framework. But also their parents announced a restructuring, I think 2 weeks back, wherein the parent of AIS, which is, or the holding company of AIS, which is in touch, will be amalgamated with one of the parent called Gulf Energy. And Singtel, which is the another parent, will take a minority stake in Gulf Energy. Okay. So the thing to note over here is that post this restructuring, expectation is that AIS will likely increase the payout ratios, dividend payout ratios. Now, what is driving this optimism is that AIS free cash flows are much ahead of its earnings. Their free cash flows, I think, are around 40% ahead of its earnings. So there is a high expectation that potentially they may increase the dividend payout ratio. Even if even Vasu, who covers AIS directly, do note that there is a potential that AIS may increase payout from 2025 onwards. And this, in our view, is an upside catalyst for AIS. To an extent, Singtel will also benefit because they own around 23% direct stake in AIS and an indirect stake through Gulf Energy in the proposed restructuring.
Got it. Okay, that's very clear. Thanks, Hussaini, for joining us. So there you have it, quite a few names to look at in the telco sector, which you can position for as interest rates start to come down. Now, another sector that is very sensitive to interest rates are the Singapore REITs. Krishna's actually done a report looking at the new leverage rules that the MAS is proposing. And this ties in very well with the question our guest, John Tan, is asking about Singapore REIT regulations as well. So, John, very timely question. Now, what the MAS is proposing is that they want to subject all REITs to a minimum interest coverage ratio, or ICR, of 1.5 times and an aggregate leverage limit of 50%. Now, currently, the REITs are subject to an aggregate leverage limit of around 45%, and they can go up to 50% if they have an ICR that is 2.5 times. Now, at an ICR of 1.5 times, it's going to be applied uniformly across all the REITs in Singapore. So that's going to simplify disclosure as well as cross-comparability for a lot of investors. And also, it'll encourage the REITs to be a lot more prudent in terms of borrowing in the sector. Now, remember, one of the biggest concerns a lot of investors had in this sector over the last year plus has been leverage, has been interest costs, and the impact to dividend yield. So some of these new proposals will help to take away some of those concerns. Plus, we think this will help the overall sector to navigate the high interest rate environment as well. And I think it'll also help the sector to avoid some of those dilutive transactions that they have had to do in the past few months. Now, having said all this, we are still neutral on the REIT sector, and largely this is because we don't have a firm view on when rate cuts are going to come. But I think it's also a good time for investors to start building some early positions, at least in the higher quality REITs that are out there, so that you have a leg in as interest rate cycle starts to move the other way. So some of the names that we like from a high quality point of view are CICT, FCT, as well as CLAR to take a position in the rate cut cycle. With that, I want to move to one of our Opportunity Plus stocks. As you know, Opportunity Plus are high conviction, small and mid cap names. And Jarek is saying that for CSE, one of his big conviction picks, a big overhang has been removed. Now, if you remember, a substantial shareholder has been selling down their stake in CSE since last year. And now we think most of that is done with and it's over. So that should take away some of the pressure that has been applied on the share price. So now with the overhang gone, the fundamentals should take over for the stocks. And the fundamentals look really good. We think order wins for the second quarter will be very, very strong, growing at double-digit percentage year on year, particularly from order wins in the US. And this is also, as a stock, one of the main things that they do is power management systems for data centers. So that feeds directly into the AI boom. So they are also a shovel supplier, the same way as NVIDIA is on the AI boom. We think the first half earnings that will be out on the 6th of August will be quite strong. And you've got a 6.5% dividend yield on the stock for as investors wait. So we got 47% upside on the stock, a target price of 64 cents. So do take a look at the price performance of the stock and do consider reading a little bit more on that in our newsletter today. With that, we're going to move to technicals, and our chart guy this week has two technicals out. The first is on iFast, where he's got a trading buy on the stock, partly driven by the most recent rebound. He expects that to continue to go stronger with the potential of the stock hitting $8.51, which is their December 2023 high. On the other side of the coin, he's got a a technical sell on SIA Engineering. Share price has been quite weak, and that momentum is likely to continue going into the next few weeks as well. So do have a look at our technical charts for more information. Quick look on upcoming events and dates. We've got quite a few events, results coming out. We are going to be heading into the thick of results season. The two big ones are the banks, UOB and OCBC, who will be reporting towards the end of the week. We are actually looking at a fairly strong set of numbers coming from both of them, with the potential for some clues on whether they will actually start to hike dividends, given the stronger performance. So that's something to watch out for as we go in, and also Citrium as well on the 2nd of August. In terms of events that we are hosting, we got a big event that is coming out on the 22nd of August, a live event hosted at SGX, where Jarek, me, as well as Gerald Wong from SGX Academy, we'll be talking about the market outlook for Singapore in the second half, but also some high conviction small cap picks for investors. So do join us. The event is completely free, so please, you can go to the SGX website to sign up for this event, or you can speak to our salesperson as well to sign you up for the event. Unfortunately, with that, we are out of time for today. Thank you so much for joining us, and wishing you a profitable trading week, and see you next week.